Good day, fellow investors. Wherever you look now, it's all about tariffs. There is this tariffs scare, recession, this or that. But when it comes to investing, tariffs might also create great opportunities for us. I have been investing since 2002, and this was a great time to be investing. Stocks went up 7 times plus the dividends, but keep this in mind when it comes to tariffs. China became a World Trade Organization member in December 2001. That is exactly when I started thinking about investing, started really in 2002, did a PhD, accumulated a lot of experience, and what we do here is value investing. And value investing is focused on price versus reward. And that's exactly the perspective I want to give you here on tariffs. Because there is a lot of news, but the news always touch just on, okay, this is now one factor, another factor, 200% tariffs of wine, champagne, and things like that. However, we have to discuss the mechanics of tariffs and how that can impact our investments. Let's start with trade. Because when it comes to trade, if you look at where am I, I'm here, and if I look at the audience here on my YouTube channel, mostly is from the United States, Germany, Canada, UK, and then Italy. So we are living in a global world. You are now consuming something made by someone unlikely in your country. However, I'm giving you information, entertaining you. The advertisements you're watching are likely from your local Google, YouTube account, so that is a benefit for you. And we all together try to improve the quality of our lives. And if you look at global GDP over the very long run, you can see here that as technology, travel, exchange, colonization, the US, migration started to move faster, we have had the best 200 years in global history thanks to global trade. Lately, the last 20 years, cheaper production, resources going around the world, and technology going back the US dollar. So it has been a global interconnected world, and we can say that the global standard of living has improved over the last 20, 30 years. The thing is that with trade, let's say this is the situation, and yes, perhaps China can reach the level of quality of life in the US. Now with tariffs, maybe the US will go here and China will go here. The US will still be a leader, but will not maximize totally the long-term benefits and quality of living. This is because tariffs are simply taxes on imported goods. In an interconnected world, there is a lot of imported goods because someone can do it cheaper, better, and you have more money to spend on other things. And that's the problem. If you need to pay more because you have to pay locally, then you have less money to spend on other things, which lowers your standard of living. That's simple mathematics. On the other hand, for the exporter, they have lower profits because they sell locally at lower prices, which means that is less investment. Globally, the world grows at a slower pace. And that's the conclusion. Tariffs mathematically will lower global growth. However, there is always the positive case for tariffs where they say that the loss will be absorbed by the exporter because the exporter has no other option. Where we live in a big world, and it is very questionable whether the loss will be absorbed by exporters. Because I just listened to the conference call. This is a spice trader from global, but from the Netherlands, and then every conference call there is a question about tariffs, and they simply said tariffs paid by the importer, not by them. If they want that, that's the price, you pay the local tariffs, and then you transfer that price to the consumer. That's how it works in most cases. But yes, that should increase government revenue. However, that should come mostly, not all, by the consumer and the exporter. So that is something to keep in mind. And then the last factor is development of local economy. There are always positives and benefits, because now there is also retaliation, so everyone that has tariffs imposed also wants the same thing in return. And then EU, first trade war, bourbon whiskey, iron, and everyone then has a decline. And development of local economy. Think about this. The US is likely the largest country with a high GDP per capita in US dollars. These are all much smaller countries, so that's the skewing effect there. But the US is leading, and is such a great production per capita thanks to this. You want to bring back manufacturing, but are you sure that you want this? Are you sure that you want more jobs with full employment? 4% is full, 4% unemployment is full natural employment. And then look at this. If you look at what is the US doing, Apple, Microsoft, Google, we already said Google is a global company, and this is the export of the US that is not even reflected in import-export things, but it is there. All these companies are global companies. Also, when it comes to manufacturing, when you make a manufacturing decision, you make it on long-term stable assumptions. We have no idea how tariffs or how this discussion on tariffs will look next week. Nobody knows. But you are asking people to make investment decisions. We don't know what you will do next week on things that are made for decades. That's also a big question. So the benefits to the local economy might not be that fast. Also, since the first tariffs were implemented, Chinese exports grew towards the US. Why? Because there are these competitive advantages that you simply cannot avoid. And yes, exporters might shoulder the cost of a tariff, but studies have shown that the burden is much more diffuse. And Walmart, Target, Costco might have to increase prices because there is simply not an easy alternative to produce or source locally. This approach is, of course, not new, and 1930s Smoot-Hawley Tariff Act increased average import duties, deepened the global recession, and also for the US. And this is now growing risk of a recession, markets are down, economic weakness, and they have increased chances of a recession. The thing is that over the long term, it will be less growth for everybody. Maybe someone gets some advantage here, some there, but that's about it. We might see inflation or less purchasing, which might lower inflation, but then it's again a recession, so there is no benefit. When I listen to the conference call, it's mostly a mixed bag. Companies will try to move, but everyone says we don't know what the tariffs will be, what will be next week, so it's high uncertainty. And when it comes to businesses are not moving when it comes to uncertainty. So we can have this block of a year of no growth because of the uncertainty. That's also a cost to everything. And keep in mind, the last 30 years were great because China exploded in economic growth, quality of life, GDP per capita, everything exploded. And keep in mind also this. China represents 20% of Apple's revenue, and Apple is 7% of the S&P 500. If 20% of that is China, that is 1.4%, if my math is not wrong. Thus, 1.4% of your pension fund, investment, market share is in China. No matter how you look at it. Microsoft, Nvidia, Amazon, global companies. Everything is global, Tesla, things like that. So when it comes to investing, I think that it's a mixed bag of fruits, and to tariffs, some fruits will get simply rotten. When it comes to investing, in general, from a market perspective, expect a little bit less. That's a given. Less growth, less returns. However, it all depends on price. If tariffs shake the market, there will be a cost of tariffs. But if the markets panic and go lower, then we as investors have higher potential rewards, because investing is a function of price paid. If you can buy for lower prices, even if it's a little bit less quality, then your returns will be longer. So that's the benefit that we can have as investors. We will discuss tomorrow a value investing strategy that works no matter what. Price, fundamentals, value, no matter what happens in the news. I'll give you a few stocks to buy on Sunday, and then you can start building this long-term, whatever happens, value investing compounding strategy.